Hi, my name is Amy. Thank you very much for watching and let's make some bad financial decisions together. This is for entertainment purposes only, so if you're entertained, please like and subscribe. I would really appreciate that. So today we're going to talk about GOOey and GOO and GOOP. Everything Google related that are high income ETFs. And before we can talk about these three, let's talk about why would we want to invest in Google as the underlying in the first place. Because usually businesses have, also big emphasis on this is just my opinion and what I have gathered. So please take this with a grain of salt and do your own research. But usually businesses have a life cycle. And so Google has had its season in the sun for a very long time. So at this point, traditionally, I would assume that our concern would be relevancy. Like, AI is coming out, are we still going to be using Google search engine? But Google actually has a lot of things going for it. Not only are they taking a really big swing at this new AI stuff, they also have robotics and cloud computing. So it's not just the forefront of AI. Like, people are going to need the cloud for their AI stuff. So no matter where they are in the there was a word I was looking for in that, but pipeline, yes. No matter where they are in the pipeline, I think that Google is actually going to win. And then I always forget that they own YouTube and Chrome, and I think Chrome and YouTube are still relevant today. And they do have new projects they're working on, like DeepMind and Waymo. So Google has a very good ecosystem lock where we are familiar with their products, and I just think that in the long run, at least for the next 2 to 3, 5 years, Google is going to remain relevant and continue to grow. So that's why if I was doing single stock investing, I would look closely at Google related high income ETFs. So I'm also doing this with the ambassador of Quan tomorrow at 4:30 p.m. Eastern Time. And me and the income architect and Max Convexity, we're going to go and discuss this. It's not really so much of a debate because there's usually one clear winner between whatever we choose. But these this time are interesting because it's YieldMax GOOY. They have been out since July of 2023, and they have way more than all of the others with assets under management with 164 million. And it pays every 4 weeks. They do a more simple than recent high income ETFs. They have the same synthetic cover call strategy. And they also added a while ago the ability to do cover call spreads, which they do not do very often, but maybe around earnings they might do it. That way, if there's a massive move to the upside, that they won't get capped so hard on the gains, or like the price of GOOY won't get capped quite as much. So it's up to the YieldMax team, and they use their best judgment. And their primary objective is they do seek current income, and their secondary objective is to seek exposure to the share price. Now, GOOW is the most recent one that came out. It came out in July 2025, so almost exactly 2 years after GOOY. And they have 19 million under assets under management. And they are not a cover call strategy at all. They have a 1.2 times leverage. So it's not an insane amount of leverage, but the way the prospectus is written is in the good times, they seek to return 120% of what the underlying is doing, and they'll return that 20% that was gained in excess. But in the downtimes and the bad times, they will return to you your implied volatility. So it's not cover calls, but it is a derivative and leverage, and you are getting paid. So their primary objective is just pay weekly distributions, and their second objective is to get 1.2 times the price movement of Google over that week period. So then we have GOOP, which I couldn't find the assets under management on their website. So we're going with, they're around $10 million assets under management. And then they came out in October, at the very end of October 2023, and they pay monthly, and their distribution rate is 13.25%. And so they are synthetic, but they have a really interesting prospectus. They can do protective puts and call spreads and calls. And they can also own the underlying. I don't know how much of it is they own. Actually, let's look. So if you go to YieldMight, and we're looking at Google related. So here in the select the underlyings, we do Google, and this has GOOW, GOOY, and GOOP. If we click into the details and then the name of the fund, this will take us to the GOOP. So what I'm curious about is, if we go to the holdings, you can see we have a cover call on Google, They have a put on Google, and so we could download the whole thing, but I don't see actual, like, they own Google at the moment. So it was, yeah, they don't actually own Google, but I'm assuming that they are just very out of the money, and that's why their distribution rate is much lower. And I have not filled out the total return section. I do like to look at it with different scenarios in the market. It's kind of like cherry picking, but I just want to know when times are good, which one's going to do the best, and when times are bad, which one is going to do the worst. So I think if we look here, because GOOY and GOOP have been out almost the same exact amount of time, from October 31st, 2023, GOOP has more total return. This is not surprising because they only have like a 10 to 15% distribution rate, and so they're more about capturing the upside. My problem with GOOP anyway is that it's only a 15% distribution rate. So when your distribution rate is that low, then it opens up the competition. And if I'm going to have a 15% distribution rate, I might as well be in something like SPY or T-SPY, or any of the VOO or the NASDAQ, like some kind of broad market fund that is giving me a 25% or less distribution rate. To me, like, that would be a better thing than to just be in GOOP, even if GOOP has more total return, because I could do, the SPY at 25, SPY with that 15%, and then with a portion of the distribution, I can just be in GOOGL if I want to get the growth from Google. It's just that it's just one of those things where, do you have a lot of money? If you have more money, then you can be in things that are less risky and have lower distributions. It's a privilege. Anyways, so now we have all three, and this is from the inception date of GOOW. And GOOW from July of this year has got the most real returns. And this is because it's leveraged and we've been on a big bull run, even though we had a few bad weeks here recently. So also, I'm not sure if Google itself actually had a worse time than the S&P 500. So it just depends on what stocks you're in. Anyways, so this is from August 20th to the 21st. And I don't even remember why I put this as a thing from the last time. I think this was just like which one did the worst or the best. But from this particular day, GOOY did the best. Yeah, I'm just trying to look to see like what did I think this was could have been a bad day. I don't know. But GOOY had the most returns. But then I was like, that's a little this one I did because the beginning, like the first week of September has been kind of bad. So I was just during the actual bull run that we've been on since May of this year, who would be the winner? And it's between GOOP and GOOW, but GOOW technically has more than GOOP, with GOOY at in last place. And then we have from the end of August to September 8th, which from my recollection has been it's been blah. It's not really a bull run. But in this scenario, GOOW has still done much better. So I think I would have to go, or I might tonight go through the charts and see what was a day that Google itself dropped a few percentage points, just to see when the underlying goes down, which one will go down the most. But overall, GOOW depends on Google itself having basically a steady upwards movement and being overall positive. Otherwise, in a down market, in a prolonged down market, it kind of cannibalizes itself. So GOOY at least is generating income through cover calls. And then GOOP, it's just the fact that it has such a low distribution rate. It might be the better high income fund just for NAV stability and keeping your NAV stable. But to me, if you're going to go that low of a distribution, as I said before, I would look towards like a QQQI or something instead. That way, I mean, even MAGY, which is the Magnificent Seven. So yeah, the reason why you would do this is if you don't actually believe in all 7 of those companies in the Magnificent Seven, or you want to overweight your portfolio in a few of the businesses. Like you want the Mag 7, but then you want extra Google because you think that the other one, like you think that it'll do relatively better than some of the other Mag 7s. So, yeah, this is interesting because it's probably more of a personal preference. Are you more concerned with NAV stability? Are you more risky and want to use the leverage to maybe get a better total return over time? Or do you want to have something that has a pretty stable NAV and uses cover call ETFs to get what you want. Up to you. So today on Financial Philharmonics, we have No YOLO, Just Yield. It's a rap song. I wouldn't say it's a good song, but I find it hilarious. So hopefully you like it too. And I also have a member video because I made this with you all. So I will publish that soon, hopefully. And speaking of members, thank you, Padraic Spalding, BGP Automotive, in my opinion, Abdullah, Jeddah, and Omega Werewolf X for making your bad financial decisions together with me. I really appreciate your support. I updated YieldMight this afternoon, so it should all be updated. And so we can see that, like, for GOOP here, the distribution amount has been pretty stable, and the price that we've recorded for it, it's been going up and down, and it's been doing that. So you can also see that if you, this is based on $100 input, if you did it 3 months ago, you would have $117 in total value. If it was 6 months ago, it would be $127, and 9 months ago it would have been $108, assuming you did 100% distribution reinvestment. So I think that's it for me. Oh, also, the reason why this is being made so late today is that I was working on my proposal for YieldMax and myself. And so this is a screenshot of what I am proposing to them. So please let me know if you like or hate this, but I think that having cards here that have different information than what's in the traditional, like what's there now, would be nice for you all, and just have the same details pop up, or modal that comes up, and then trying to get them to pay for a advertisement on the right hand side, and they may or may not have this left hand side one as well, but I doubt they will if they do the right hand side one. So it'd probably just be this right hand side and these featured ones, but this is just something like a quick glance that you can see some of the tickers and what their distribution rates are. So I'm pretty excited. I'm going to sign this and send this over to them soon, and I will let you all know if this is going forward or not, and I will check the contract to see whether I can disclose how much the deal is. But yeah, it's really exciting stuff. I will talk to you later. Bye.